Coming up today, S&P 500 finishes slightly higher. Wholesale inflation comes in hotter than expected. Buffett buys a dip in United Health. Miami International hits the market. Why aren't stocks selling off more? Trump and Putin to meet tomorrow. And what stocks billionaire hedge fund managers are buying right now? You might be surprised. Let's go, guys. And I'll say it again, there's nothing more entertaining than financial markets. Another interesting day out there today, as we are halfway through the quarter. And just like we get 4 times a year, 45 days after the end of the last quarter, hedge fund managers are required to report their activity and positions to the SEC with their Form 13Fs. And so I'm about to show you some of the trades and portfolios of the biggest hedge fund managers out there, causing some moves in the market today, including Bill Ackman getting into Amazon and a whole bunch of fund managers getting into United Health, as it's up about 10% after hours as I speak. We also got a hotter than expected wholesale inflation print, PPI, all of which caused the S&P 500 to gap down a few points before it was bought. And here's a look at the S&P 500 ETF on the 5-minute chart. That's when the inflation report hit the wires. The market sold off 5 minutes before the dip was bought, and it didn't even revisit those lows for the rest of the day. So technically the market held up really well here today, and that's what I'm going to get into later on this video as well. We're going to dive underneath the hood of inflation, what drove this hot PPI print, and has that really changed things for the prospect of an interest rate cut next month. But first, let's cover some of the moves from billionaire hedge fund managers out there. United Health, ripping up here after hours as I speak, now getting back to almost $300 a share, and I can imagine a lot of retail investors are feeling pretty good right about now because they have been buying the dip on this name the last couple of weeks. I was also fortunate enough to make a profitable options trade on it this week that I share with my members, and it did get super cheap down there at $234 a share. It looks like we're going to open tomorrow somewhere around $300 a share. And that's thanks to the world's most successful investor, Warren Buffett, having bought the dip, more than 5 million shares over the last quarter, as the stock has been pummeled on the back of a number of issues. They pulled their earnings outlook, CEO stepped down, and this is on top of public blowback against the rising costs of healthcare. And Buffett himself has been critical of the US healthcare system, actually called it a tapeworm on the economy due to its high costs. And he's no stranger to United Health. He previously invested in it almost 20 years ago, but he sold out on the cusp of Obamacare. But he obviously sees value there, and it's a big enough company that he can get a decent position in and potentially grow. And there's a look at the activity in Buffett's portfolio this last quarter. The Berkshire portfolio now has 41 stocks, a bit over $250 billion in value, and he actually sold a few Apple shares, a few Bank of America, not too many other changes to his biggest positions. Interesting to note, he's continued to buy the dip on Chevron as oil and energy stocks have been weak of late. Also added to Constellation Brands and picked up a few more shares in Domino's and Pool Group, a residential pool company. Also interesting to note, he was buying the dip in a few home builders. D.R. Horton, America's largest home builder by volume, and Lennar, another major US home builder, which as Zero Hedge says is interesting. You wouldn't expect him to buy home builders over this past quarter if he expected rates to go up, as they're quite sensitive to interest rates. And in fact, home builders did have a little dip there today, but have been one of the best performing sectors this last month on these big volume pushes coming back in. Also interesting to note, one of the most successful hedge funds of all time, Renaissance Technologies, also picked up a few shares in United Health, along with a few other noteworthy fund managers as well. It's helping to push up the entire healthcare sector after hours as I speak, as this sector has been crushed, and no doubt there could be some good value to head there for long-term investors. Just moving on, looking at Bill Ackman's latest moves and portfolio. He added to Brookfield Corp, who are a large fund manager, and initiated a new buy, Amazon, almost 10% of his portfolio, over $1.2 billion in value, which was interesting to see. And Amazon significantly outperformed the market today after being sold off after its earnings 2 weeks ago. Even though they came through with a massive beat, looks like the dip was bought, and it's showing plenty of technical strength here. Also interesting to see with Bill added more to his position in Alphabet, and when you combine both voting classes of shares, now got about 15% of his portfolio in Google, which would make it his third largest position, and he's still got Uber as his biggest. With it too looking pretty good on the chart and consolidating here, holding up well after its earnings. Now to one of the most interesting guys in finance, but nowadays only with a relatively small portfolio as he manages mostly his own money. Michael Burry, as portrayed by Christian Bale in the Wall Street classic movie The Big Short, was previously just long Estee Lauder, beaten down beauty company with a whole bunch of puts and everything else. Looks like he's getting bullish again. And as he quite often does, he hunts around for deep value. And just as I made a case last week on Lululemon potentially being cheap, looks like Michael picked up 50,000 shares in the beaten down clothing company as well, along with Bruker Corp, a medical company another biotech, and Mercado Libre, which is kind of like the Amazon of South America. Pretty decent sized company, 117 billion market cap, and he too also bought the dip in United Health. There's a look at Lee Lu's portfolio, the late Charlie Munger's protege. He picked up Chinese internet retailer Pinduoduo, which is also an undervalued Chinese internet retailer, and still has his largest position in Alphabet Google at a combined 32% of his portfolio. Another one of the best all-time value investors, Seth Klarman, him too also adding to his largest position in Alphabet Google and a few other of his long-term held positions. And finally, David Tepper, one of the best hedge fund managers of all time, making some significant moves to his top holdings. And what we can see is that he's been reducing his exposure to Chinese-related stocks while significantly increasing his position in Taiwan Semi, Nvidia, and him too bought the dip in United Health, his second largest position, buying almost $765 million worth. And like Bill Ackman, he's seen something in Amazon that made him buy more shares. And he also just got into Intel, which along with my option members, I'm currently long as well. And we're getting a nice little rip here after hours. On backer news that the US government may invest in Intel to support US manufacturing, just like the Pentagon did with MP Materials. And we've seen the admin partner with Nvidia and AMD to sell chips into China. We're going to see more and more pro-capital moves from the US government looking to directly support American companies of strategic importance, which I've been arguing this entire year. Intel's near the top of the list because they have the infrastructure to help America's drive in onshoring a lot of chip production. As everything runs on chips these days, it's very important for national security. And that's what I've been leaning against every time I've been taking a long trade in this, buying the dips when it comes down to support and when my indicators are telling me it can be a good time to get in. Also hitting the market today, Miami International, MIAX, derivatives exchange, as the IPO market is heating back up, getting a lot of hot names coming on with more to come. Plenty of unicorns out there, private companies worth more than $1 billion, seeing the market at all-time highs, premiums being achieved for IPOs, and this one too had a very good first day, being priced at $23 a share, opened up at 31, finishing at 30. Not as massive rip as what we've seen lately, but still finishing at a 30% premium to the IPO, but not quite the popularity with traders as was Bullish yesterday, which had a crazy day. High of 118 and a low of 68 where it closed. Continuing to be well traded here today. And a recent IPO I've got on my watch list for a potential dip buy bounce swing trade. Using options so I can get the exact risk reward that I want is Figma, AI-powered design platform. Like we can usually see, runs up out of the gate, then gets dumped, insiders cash in, and then the selling kind of dries up. And so I'm waiting for my reversal signals indicator to give me a bullish signal on this before potentially initiating a position. Same with Circle as well, the company behind USD Coin. They did come in with an earnings miss because of CapEx. Revenue still growing more than 50%, but they did a secondary. So the stock's getting sold off after that. But again, I'm waiting for some reversal signals as I think this is a good candidate for a bounce play as Ethereum is rallying up to highs. Platform stablecoins are being built on. And stick with me because I'll come back to some other hot stocks out there today, including OpenDoor and a few other retail favorites. But first, let's just take a look at the latest print we got on PPI, wholesale inflation, the producer price index. And that is how much are the prices going up for the companies that basically make and sell stuff. So no doubt it came in hotter than expected, 0.9% in July. Economists were way off again, 0.2% expectation. And so what drove that? Well, a big part of it was food, especially eggs, which actually advanced 7.3% in price last month. Seen meat going up quite a bit too, and a little bit on electronics, 3.8%. And so they're more vulnerable to tariff inflation. And even though we're getting a bump up here, again, I'm going to make the argument that that's a pretty good result, considering tariffs have been in effect for several months now. And this is probably one of the most exposed categories. And so there's a look at the raw data. No doubt it is the highest print we've got in a couple of years, but we're not seeing an uptrend. That is the moving averages of this data. So it still could be month to month noise, because just looking at the annual change, which did have a little bit of a bump up, 3.3, but that's still lower than what we saw in February, what we saw in January, and what we saw in December last year. And so it's kind of normal to see this data ebb and flow. If that were to break out above 4% in the coming months, then for sure that's something to note and would technically represent an uptrend. But if the market was really worried about a stagflation scenario, grinding economic growth whilst inflation keeps increasing, then the S&P 500 wouldn't have finished flat today and the dip wouldn't have been bought, and we would have likely seen yields shoot up like crazy. Fact is, they didn't even take out yesterday's highs. Looking at the 2-year here, still on 373. And so it's no surprise a lot of people don't understand this. Why isn't the market selling off harder on this worse than expected inflation? Isn't that what everyone's worried about? tariffs are going to cause inflation, which is bad for consumers and businesses and the stock market. And there is plenty of that skepticism out there. In fact, we just saw the highest print in a couple of months on the latest AAII investor sentiment survey that we got yesterday. 46% bearish reading, getting pretty low there on the bullish readings again. So a few things. Whilst yes, ideally PPI and every other inflation measure keeps going down month after month, the reality is the US economy is still growing at a healthy clip, just having printed 3% annualized growth in Q2. The forecast for a similar print in Q3 and Q4, and corporate earnings at all-time highs, growing double digits year over year and forecast to accelerate next year thanks to AI. Even though for sure we do have some signs of weakness in the economy, but a lot has changed over the last 5-10 years, with the wealthy being the biggest drivers of the economy now, and they're still spending at a record clip. And when you strip out food and energy from the PPI, the month-over-month increase was nowhere near as bad, 0.4%. We just got a really healthy print there on food. But again, that's not driven by tariffs, because the fact is 85% of the food that Americans consume is made on American soil. The US only imports 15% of food and beverages. And so let's just think about that for a second. Goldman Sachs has estimated that the terminal global average rate on tariff is going to be somewhere around 15%, maybe 17%, maybe 12%. And yes, it'll be a little higher on China, but that's just going to incentivize production elsewhere, in addition to incentivizing even more domestic production. So worst case scenario, we get a global average US tariff rate of 15%. And so it's just a tiny immaterial impact on food. If only 15% of food is only going to have a 15% tariff, that's just a tiny little bump up to overall food pricing. And food is a big part of the consumer price index. And that's all that matters at the end of the day, because if producers, importers, exporters, distributors, retailers all eat some of the tariffs and prices don't materially go up for consumers, CPI, then it shouldn't be such a big deal. And with corporate margins at record highs, there is room for a little bit of a pullback in corporate margins to help absorb these tariffs. But again, that could be counteracted by the US government, potentially on its way to $1 trillion annualized in tariff revenue. They're going to spend all that back into the economy. And so you got food and beverages and transport at about an equal second largest category for CPI. Crude oil's been coming down, and Trump has exempted pretty much every form of energy, oil and gas, from tariff. They don't want inflation. They want rates lower. They want the US dollar lower, and they want GDP to explode. They're trying to usher in America's golden age. Now, the biggest component of CPI, housing, is mostly exempt from tariffs to begin with, as it is looking at rent and owner's equivalent rent. But of course, tariffs can play a little bit into that with the cost to build a new home. Of course, apparel. Most clothing's made offshore, but it's only 2.5% of CPI. A little bit of medical care as well, with importing pharmaceutical products. But again, the US admin's trying to work to get US drug prices down. And of course, recreation. A lot of that's discretionary and exposed to tariffs. But again, supply chains will get rejigged, along with other industries as well. Markets are pretty efficient at finding the cheapest route to get products to market. And looking at the latest data from Trueflation today, which track over 10 million prices in the real economy in real time, they still think it's tracking around 2% US inflation. And same with interest rate traders. Though we did see the odds pull back a little bit today, they're still pricing in 92% chance the Fed will cut next month, which I think Jay Powell, for himself anyway, is in between a rock and a hard place, because he could use this last PPI print as an excuse not to cut, which is actually in defiance of the Fed's own inflation expected model. Looking at their website, the 2-year expected inflation's actually come down this last month to 2.34%, and they use a combination of treasury yields, inflation data, inflation swaps, and survey-based measures of inflation expectation. And again, just looking at a market-based expectation of inflations, the spread between tips and treasuries pretty much finished flat here today, along with commodities versus treasuries. Another measure of inflation expectations, largely been consolidating this entire year. So as I've been saying pretty much this entire year, we shouldn't be surprised to see a few little bump ups in some prints as tariffs get absorbed into the economy. But at this stage, we're just not seeing a huge and material breakout and uptrend. Could still be within the normal ebb and flow of this data. And the fact is we've still got GDP and corporate earnings growth that could be still overwhelming inflation fears. And that's not to say we can't get further bump ups over the next month or two, but this administration is very reactive and flexible to what's happening. And as the data shows, a lot of this PPI print came from increasing food prices, and America only imports 15% of its food. So again, I'm going to stick to my argument that tariffs shouldn't cause big structural inflation, just a little bump up. And I guess we'll have a clearer picture of that as the year goes on. Moving on to crypto, we just heard from Treasury Secretary today that Bitcoin that has been finally forfeited to the federal government will be the foundation of the strategic Bitcoin reserve that Trump established back in March. In addition, the Treasury is also committed to exploring budget-neutral pathways to acquire more Bitcoin, to expand the reserve, and to execute on the president's promise to make the United States the Bitcoin superpower of the world. And even though we got a bit of a technical sell-off in crypto there today, looks like crypto didn't like that PPI print more than stocks. Fundamentally, can't get more bullish than the US government outright stating they want to be the Bitcoin leader of the world. Not to mention getting fully behind stablecoins as well, with the Genius Act recently passing. Ethereum too taking a little bit of a breather here today. Again, not surprising after its amazing run-up these last 2 months. And just before I get back into the charts and show you what's moving out there today, Trump and Putin set to meet in Alaska tomorrow to discuss ending the Ukraine war or a ceasefire or some other negotiation to see progress in this war that's been raging for over 3 years now. So it'll be interesting to see what comes out of that. Commodity markets don't appear to be on edge at all. In fact, the oil VIX, just like the stock market VIX, is down near yearly lows. Same with the gold VIX, just not moving much at all here, and it's actually pulled back a little bit off highs and has been consolidating for the last few months. Just looking at what else is moving out there today, bit of a pullback in the nuclear related stocks, in addition to space stocks experiencing a little bit of softness. Quantum stocks still consolidating, but still looking pretty good on the weekly chart here. Looks like a massive bull flag on D-Wave Quantum. I've got this one on my watch list for a bullish setup, along with Oscar Health. The dip is appearing to get bought. We do have a bit of softness in these larger tech and software stocks like Salesforce, HubSpot, and others like Snowflake, MongoDB, and some of the cybersecurity stocks as well, having a bit of a pullback. But defense, aerospace, and drones, they're still holding up pretty well, along with fintechs. There's Robinhood, just a few points below all-time highs. Interesting thing about Robinhood is no doubt the stock is going to be leveraged to market sentiment, high beta stock, but when things get crazy in the market, people trade more. That's great for the brokers. And look at that shallow dip back in April when the market got created, especially high beta stocks. Robinhood stood up, it was grinding there on volume, and it's been up and to the right ever since as retail volumes continue to break out. Rare earth stocks as well could be trading in a world of their own. You could kind of think of the bottleneck to AI's growth as being electricity. That's why all these nuclear stocks are doing well. But you could kind of think of the bottleneck to robotics growth as being rare earths, very important for robotics. And just like crypto and semiconductors, we're seeing direct US government support for their very nascent rare earth industry. Still very, very early days here. And again, we're getting other retail favorites like Open Door Technologies. Rip up there today. Still plenty of mixed breadth out there. Along with Bitcoin miner Tariff, monster rip today, 59% after securing some really new big deals. And look at this on Newegg, absolutely going to the moon, up another 39% today. This is a huge squeeze. Likely going to print a blow off top soon. Then you watch, it'll have an epic dump as well, back to the 50-day VWAP at least. And just looking at the VIX index, just a slight little bump up there today. Volatility market, not looking too worried about PPI. We've actually still got a really deep state of contango. Volatility a lot higher out the back than up the front. Meaning option dealers are not seeing a whole lot of volatility anytime soon. They're not always right, but they mostly are most of the time. And just wrapping it up with a bird's eye view of all trends out there. Still got volatility and 2-year yield downtrending across the board. Pullback in gold and energy, and still a bit of a pullback in more defensive sectors like staples, utilities, somewhat with REITs. Getting a nice bounce in healthcare. Inflation expectations haven't bumped up here in the short term. The dollar's still downtrending, and global equities are still got strong breadth across the board. And the S&P 500 could barely crack a 30-point range today on what was supposed to be a shocking inflation print. It just gapped down a few points and then was bid up. We did see the Russell 2000 come off a bit more, 1.29%, maybe a bit of a correction from those 2 outsized days we just had. But again, looks like the dip was bought here on a low range day. And there's a look at the Qs as well. NASDAQ just sitting below all-time highs. So tomorrow could be an interesting day. We've got retail sales due out, consumer sentiment, along with OPEX, the third Friday of the month, options expiry. Thanks for sticking with Click Capital, and I'll see you back here again this time tomorrow. Cheers.